what is a contrarian in the stock market, and should you be one?
Well, yeah, a contrarian is someone who isn't going with the herd. They are taking the opposing view. And there's absolutely no doubt that contrarians can be very successful. I mean, a very obvious example of this would be those guys who bet against the housing market back in 2007, 2008. But one of the features of contrarians, those guys included, was that you can be, if you're going against the herd, the herd has a lot of power and momentum quite often. So you can be wrong for quite a long time. And as Maynard Keynes said something along the lines of, the markets can remain irrational longer than you or I can remain solvent. And that's the thing. So you could be contrarian for all the right reasons. I mean, you could have looked at the Northern Rock stock back in 2007 and said, this is an absolute disaster. I mean, these guys' loan book, it's absolutely crazy. But Northern Rock, the share price continued going up for a very long time before actually everything became clear that the bank was in dire straits, and then it plummeted. So really, it's a good thing. It can be a good thing to be, because of course, if you get, the herd will run with something and generally speaking take something too far in a particular direction, and then suddenly realise, oh my God, something's really badly wrong here, and reverse out very, very quickly. And there, as a contrarian, that is where you can make profits, you can make money. But quite often it involves shorting the market. Not really a problem with indices, a little bit more problematic perhaps with individual stocks. And so, yeah, I mean, and the other thing, of course, is sort of it's a question of defining what a contrarian is in any particular environment. I mean, I suppose you could say, well, if it's just going against what's happening in the market. But I mean, there are plenty of people out there talking about stocks at the moment and the bond market at the moment, and saying that both are really overvalued and are due to come off. You wonder whether that's such a contrarian view anymore.
Is there a greater inherent risk in shorting shares? Because there is a saying that the stock markets tend to go up in the long run.
Yeah. Well, there is a risk in shorting shares because the thing about stock markets tends to be that when they fall very fast and quite dramatically, and so there's a great attraction to shorting stock because you can make gains very, very quickly. However, a stock can only go to zero, whereas theoretically it could be it's priced for infinity. There's nothing to stop it going up to all kinds of ridiculous levels. So there is an inherent danger in shorting. And I suppose you're absolutely right as well. I mean, if people hold stocks for the long term, there is the dividends that they're getting paid on those stocks in some cases, and so that's all sort of good reasons. There are pension funds, there are investment management funds, there are all kinds of entities who are naturally going to be buyers of stock. But having said that, there are times when the market's going to sell off and people are going to liquidate those positions. And if you can time that right and you happen to be short at that time, great. But yes, I mean, that shorting stocks is inherently risky, but sometimes it can be risky buying them as well.